We're back in 2025 and we are bringing a big live session. Tonight is all about how to grow your property portfolio in 2025. Where are the areas that are set to grow, but also where are the areas that have the potential growth to continue your property portfolio journey? Because what I'm starting to see in the data, and we'll cover a little bit of this, is we're starting to see some markets top out. So yes, they may have some future capital growth to go forward, and 2025 may have them as the winners. But are they actually the best markets to be buying in? Hey everyone, my name is Joe Tucker, and together with Jeff Mars, we created Oz Property Investors, Australia's largest investment community. Each week, we interview top property experts, and this week is no different. We're starting the year off with a bang. We have Jeremy Iannuzzelli of Pradium Partners, an incredible accountant that talks all about the accounting world, but also where he is seeing clients sell their properties. So where are people actually buying, but where are they most importantly selling? Because those people leaving, where are we seeing the opportunity? Then we have Mike Mortlock of MCG Quantity Surveying, and he has got full slides that actually talk to the data. And we will say something crazy, then outrageous, and look at, just letting you know, the 180 days of old listings from WA has dropped 50%, opening up a large supply of value there. So jump into the session, check it out, do the comments, do the like, do the subscribe. You guys know what to do. Let us know your thoughts to this session, and let's jump in.
I think the property market will be somewhat similar from a national growth perspective next year. I don't see any fundamental changes. I think the elephant in the room of rates will have an impact on sentiment, but we're not going to see interest rates 2% lower by the end of the year, right? So it's still going to be about affordable markets. And we're looking at markets like Perth now coming from second last to right up there. People are going to have to look further afield to be able to transact for sub $700,000. So I still think it will be about affordability, but it won't be a bit necessarily as much about affordable capital city markets because there aren't any apart from Darwin and Hobart. Will this sort of see Hobart's resurgence? I think there's still a few issues with stock levels in Hobart. I do actually think it's due for a rebound, but it's probably going to be late 25, early 26 for me. I still think we're going to see some movement in Perth, Adelaide and Brisbane, but I'd be expecting it to be at least sort of half the pace of what it has been. But the real movers, the boom locations, I think are going to be those regional locations that are just supported by good affordability metrics, good infrastructure pipelines and great employment opportunities. Some examples of those could be along the Inland Rail, where we've got places like Albury, Toowoomba. We've obviously seen a lot of people investing in our data in Toowoomba, and there's still some affordability there. But I do think that some of those North Queensland markets, like the Townsville, like the Gladstones and like Mackay, now they're not all the same just because they've got a nice climate. They've got a lot of different things going for them. And I think, Townsville is probably the pick for me in terms of the diversification of the local economy. That's probably the best I can do for someone that doesn't spend their head, looking at the days on markets and vendor discounting and that stuff day in, day out like you do, Joe.
Yeah, well, it's just kind of looking at it from a macro perspective, and I think you're spot on. We have a serviceability problem. We have a borrowing ability problem. We are not going to be able to go out there and buy a $1.5 million asset. So those are the markets that are not going to continue to go up. The bottom, I like what we brought up here before, was talking about the top quartile and the bottom quartile of the property market. And I think that some people just need to, as investors, we have to realize that this bottom quartile is now not $300,000. It is now $550,000, $650,000 is the lower quartile of the market. But we are absolutely going to be hemmed by, in 2025, our borrowing ability and serviceability. So those affordable markets are 100% going to drive. And also the affordability from a cash outlay perspective, the places that have good solid yields are going to do quite well as well. What I would be focusing on the most as an investor, and Jeremy, you love talking about this, is net yields. After all is said and done, right? So some of these regional places have high insurance, and they also have high council rates,
and high repairs and maintenance as well. I think a lot of people forget that being in these very climatic conditions and very vast climatic conditions, that increases your general wear and tear on the property. So that's, sorry, Joe, to interrupt. Apologies.
Yeah, no, it's spot on, because that's your net outgoings, right? The biggest thing I think for 2025 for me is supply. That's what you should be looking at, right? Demand is one of those things that kind of fluctuates and can kind of change. Supply is set, and focus on the areas that have limited supply coming on, because that's what takes 48, not 48, takes 2 years to kind of come online. It's that balance of supply and demand that drives capital growth. So if you can buy an area that has low supply coming onto the market, that's super affordable, and then buyers can afford to buy there, that's going to be the best spots for you. Mike Mortlock, you have provided a wonderful little slide here that talks to the things that are on everybody's lips. Interest rate cuts.
Oh yes, my screen's too small.
A little bit.
Yeah, well, I think that's the big difference between 2025 and 2023 and 4 is that we almost certainly will get a rate cut. This isn't live, is it? I've said that now. Something's going to happen.
Yeah,
because the US dollar's doing so well that's a cause for concern. That if our dollar's so cheap, it can be quite inflationary for goods and services. And you can actually see that in the GDP print with agriculture and fishing and mining. I think it's the only one that went absolutely bananas the last time, but we are probably going to get a rate cut. So if you look at the trading day, 30th December, there was a 67% consensus that we would decrease at the next meeting. And then from the day after, it went to 73%. On the 8th of January, I don't know exactly what happened, but it went up to 78 for a bit. And I think we're back down at 73% from 2 days ago. Of course, that's going to have that's going to make a difference. And I think the election has to be, Jeremy, does that have to be by May 18th or thereabouts?
Well, he'll call. Yeah, it'll be something that he has to call it by then, but not necessarily does it have to be by then.
Yeah, right.
But Michelle will be keeping her ears open for that, because she doesn't want to. This is Michelle Bullock, the Reserve Bank Governor of Australia. She doesn't want to be playing favourites, and the RBA do go into their shell a bit and do remain quite coy, especially in election years. So it's interesting, because you saw Westpac and ANZ, I believe, talk quite heavily around interest rate cut rhetoric. A couple of banks said probably not, and all of a sudden now we're starting to see a couple of them backtrack. So I wouldn't be surprised if that percentage starts to drop further and further as we get closer to the meeting in February, mid-February, I think it is.
Well, I was looking at the predictions for the banks, and CBA has it pinned for February at 3.35 by December 2025. Westpac has it at a May drop at 3.35 by the end of December. And then NAB has it in May, and then ANZ has it in May. So CBA is the only one that believes it's going to be in February, and the rest believe it's going to be in May.
You've got to have the vested interest from CBA holding the largest amount of residential loans in Australia. But in the two-horse race, always back the one with self-interest, 100%.
Yeah. But I tell you what, if there is a February rate cut, how many seconds before Labor call the election? Because they're going to want to run with the wind in their sails from something like that if it happens, right?
Yeah, absolutely, and that's why, as I've said, quite openly, the last time a rate cut happened prior to the election, believe it or not, was when rates really used to move. It was the election that John Howard and Kevin Rudd had in 2007. The election by memory was in June, and the RBA raised the interest rates from 6% to 7% in May of 2007. And John Howard, to this day, in all of his memoirs, says that that was what lost him the election.
Well, you remember the good old days of 100 basis points?
That was when rates moved. They moved at 100 basis points at a time, 50 basis points. None of this 0.1, 0.25 death by 1,000 cuts. You want something to happen, you raise the rates and you hammer it down. And you want your economy to do well, you drop the rates like what they did in COVID, slashing rates at 0.75%. And we saw how quickly the market reacted to it. So it is a slow-moving beast, but it's a slow-moving beast because the politicians and the bureaucrats involved make it that way. So no one wants to be heralded as the person who smashed the economy.
House versus units purchases per state on the next one. There you go. So in New South Wales, 54.8% of purchases were houses, 33.9. Now that doesn't add up to 100 because we've got, granny flats and duplexes and all sorts of weird different things. But that gives you a bit of a breakdown. So 82% of investors are buying houses as distinct from 11.9% of investors across Australia buying units. And I've seen that as high as 50-50 in a financial year before. I'm actually quite glad that investors are choosing houses rather than units, especially if they're not the older style bulletproof ones.
What about the shift to affordability? Are you starting to see people be more attracted to the yields that units provides and become more of affordable assets?
Only anecdotally. I've done a couple of podcasts with people talking about the price differential between houses and units and in places like Sydney and Brisbane. Let's say blue chip places in Brisbane. In some locations, there's $1 million price disparity between a house and a unit. Yeah, of course, you're getting more, but there is a tremendous amount of pull for people to come into a community to purchase a unit to be in and around, the houses and the beautiful location in the area for $1 million less spend. So I'm seeing anecdotally people are taking advantages of that, but it's not sort of entering the data where we're seeing a meaningful uptick in the amount of people buying units. I think historically, as far as our data goes, it's at a low point. I don't think we've ever seen it under 9%, for example. So it does make sense. I mean, if there are still affordability constraints, then people may choose units rather than houses for a cheaper price point. But I think rather than that, there's still probably opportunities in regions to get houses for a cheaper price, especially if they believe in the local fundamentals.
And I suppose what this also tells you as well, two things. Number one, from a client perspective, I don't think I've seen a client buy an investment property that is a unit for the last 12 months. And I could probably openly say that I haven't seen any clients buy, from an investment perspective, a unit. A couple buy homes that they want to live in from a lifestyle perspective, but not investments. But what that also tells me is that developers are looking at that data and they're noting, and that's why there's a substantial amount of units that are still sitting as stamped, planned, ready to go, but haven't been built. And I know of many very large developers that are holding off on 30, 40 and $50 million developments because they just haven't got a target market to sell to. And that means that there could be, and again, maybe a positive thing, a bit of silver lining, is there could be this little bit of green patch that may arise for units probably being a little bit undervalued while stock levels might be relatively low. And then if you're smart enough to swing that transaction, and no one's going to be able to tell you the bottom and the top, but one would probably say that units will have their time in the sun. May not be forever, because as soon as they do start to become, again, profitable, that's when you see developers who already have buildings and plants ready to go. So we're not lagging 2 years for them to construct. They're ready to go and have it been built in 18 months. That's when you might want to say, well, okay, I'm ready to take advantage of the money that I've made and I'll move that on to maybe a house. So there is some opportunity there if you're willing to treat property as a business and get the right level of education to know when to get in and get out and almost treat it like a trading stock rather than a very long-term investment.
Yeah. And do you typically see people doing that successfully, or is that just a very sophisticated game that people play?
Probably not successfully. I will though say I remember seeing a large number of clients in about 2013-14 buying 10 units off the plan. 10 units off the plan and doing simultaneous settlements on those 10 units in, say, 2 years' time, 2016, and making millions of dollars, millions. And it was just awash with money. And these people were trying to tell me to get involved. And I said, guys, so you've got to be careful. You've got to be able to make sure that you can fund and settle these properties, because if the door comes knocking, they've got to get paid. And then lo and behold, banking roll commission comes, and those people won 3 or 4 times, but then lost it all on that 5th one during the roll commission. So if you're smart enough and you know when to kind of exit and throw your cards on the table and walk out of the poker game, there's a lot of money was getting washed around in those heydays of just people buying and signing a contract and making 300 grand by the time the land was developed or the unit building was built.
Okay. Can we address the cash flow equation? If we're borrowing at an 80% cash flow is negative, more generally, what does the LVR need to be in today's climate to have a neutral cash flow?
I've done this equation about 30 times with clients. I've actually got this pretty much at the back of my head. If you're buying a property with a 5.5% rental return, which one would argue to say is quite strong in this particular market, and a 6.5% interest rate, and let's say the purchase price was 600 grand, because I've modeled this on this number, your leverage would need to be about 67.5% to become generally cash flow positive.
Pre-tax?
That's pre-tax.
Yep.
So that's before the magic happens at MCG with the lovely quantity survey tax depreciation reports that you guys provide to bring it into a significantly better position post-tax. But I've done those numbers, and it's only at the moment where, again, yields are so low, interest rates majority at 6.5%. That's where you need to have roughly that 70% LVR to get it into a position where it's breaking even. Those numbers will change depending on prices and holding costs. Some areas have far substantially higher holding costs, and it could be due to repairs and maintenance, age of the property, a lot of metrics that go into it. But to draw a line in the sand on those numbers, about 70% gets you into a more neutral cash flow.
And that's probably the shift that I would like to see property investors making in 2025, is not chasing the yield. Chasing the yield is going to be a bit of a fool's errand beyond 2025. It is going to be just chasing the yield. You need to focus on capital growth, and where is the capital growth going to give you the most amount of bang for your buck? Yield is fantastic. Like, I hate putting on my website 6.5, we were buying at 6.5% because that was the best market for capital growth and the balance of cash flow. Those markets now are no longer the cases, and those numbers no longer exist. And that's just the reality. So our goal as investors is to buy the best property in the best location at the best price for our buyer brief. And it used to be a 5-6% yield would give you the capital growth, and we've seen that in the Townsvilles, we've seen that in the WAs, but that is no longer the case. From a net overall return on investment, you are going to have to focus more so on a 3.8 to a 4.5% yield. This is what you've pulled up from depreciation deductions. Are some states just better for deductions than others, Mike? What are we looking at here?
Great question, Joe. Some states are, I would say, fundamentally better for deductions, like ACT. Think about it. It's a tiny little state that didn't exist until we invented it, and then we filled it full of highly paid public servants, and we built heaps of apartment complexes and towers, and nothing is really, really old, and everything that was old is fairly well gentrified because it costs $1 billion to get in there. So, I mean, you can probably see that quite clearly in the ACD data, because if you think about the properties that are the best for depreciation deductions, typically they will be units rather than houses. If they're units, they'd be typically in bigger complexes rather than smaller. If they are houses, they typically would be newer rather than older. But if they are older, they'd be substantially renovated. So yeah, sometimes just because of the peculiarity of the types of dwellings that people build in different states, that can have a bit of an influence. But I must use my little catchphrase that's depreciation is a bonus, not a strategy. So no one should be looking at, oh, I see there's heaps of opportunity in ACT for depreciation deductions. Maybe I'm going to start looking there for my next investment property. No, like that's a bad idea. The difference between a good investment property and a bad investment property is far wider than, say, $20,000 a year worth of depreciation deductions. So no one should ever really work that way.
Agreed.
Yeah. I want to get your guys' predictions for capital growth in Australia, but we've got total listings. Do you think the Australian property market will follow the listings, Mike?
Well, that last slide, I think, is distressed listings. The reason why I put that up there, because I was looking at this in the market update for the Property Trio podcast that we do once a month. And so there's new listings, there's listing volumes generally, and there's distressed listings. So amazing to watch Perth, just Perth, Adelaide, and Brisbane really in concert. Like really, anytime you saw a contracting supply of listings, it correlated with property price growth. We actually saw like quite a lot of stock come onto the market in Perth in the last little while, but if you look at it over the long term, it's still historically quite low, whereas we've got further stock constraints in Adelaide, and I think Brisbane is there or thereabouts. But I think listings, when we talk about supply and demand, I think in 2024, we've been sort of led by politicians to think supply is building new properties. And sure, that is a type of supply. But I think even more important for us to consider is the supply of listings. So, if we've got a tight market where people aren't selling and there is, a reasonable level of demand, then you're just seeing more competition in the marketplace. So, yeah, looking at the old listings greater than 180 days, if you look at, say, Perth, like it has a yearly change of, negative 50%. Wow. I mean, that kind of says that the properties that stick in a market that isn't red hot are selling, right? The ugly duckling properties is another way of putting it. I mean, that just goes to show how much heat there is in the market when you see such a huge contraction of these aged listings. They're old listings, possibly because they're overpriced, but more likely because they're undesirable, but they were getting snapped up at the peak of the market. And to some extent, they are still getting snapped up. And look at the red figures. Brisbane, Perth, Adelaide. What do we know about 2024? Those were the three markets that kicked ass.
Yeah. And the interesting thing is, before Brisbane, Perth, and Adelaide started to kick off, the conversation that we would be having in 2020 and 2021, looking at the data, would be very different. Like we wouldn't be exactly. They were the worst performing. So when we say, it's hard as an investor to look at these charts and be like, oh, well, this one's done so well, we need to be buying the market that's done so well. Not necessarily. There's a lot more to it, and you need to be contrarian as an investor, because that's where the opportunities lie. It is choosing those markets that have the most amount of, for me, it's the supply story. Like, you can't change the supply story, and the demand is a big part of it. Obviously, the supply and the demand, but go to where the markets have the least amount of supply, and I think you would do quite well.
Yeah.